Welcome to the Anton Stentner podcast. And today we're going to be talking about home price predictions for 2025. So, Anton, are we going lower with prices or higher with prices?
I think let's look back in time. The news media, the crash bros, they said 2022 it's going to crash. 2023 it's going to crash. 2024 it's going to crash. It didn't happen. It didn't happen in the face of high interest rates. And so we're going to talk about what actually happened in 2024 with U.S. national home prices. And then we're going to look forward and say, okay, what are all the major economic houses predicting for 2025? Then we're going to finish up with this idea of, well, what would cause prices to crash? And what should we be watching for that could actually cause them to rise dramatically? That way, depending on how the economy goes, or in the words of our man, Papa Powell, the totality of the data, as it comes out, our listeners will know what to pay attention to.
And so are we going to be focused on national trends, or are we going to also talk about Seattle too a little bit?
We're going to go through the national, and I think we're going to end just real quickly with what's happening for our local people here in the Seattle metro, because we know a lot of you are tied to us right here.
Yeah, but the reason I asked that, because of course, at the end of the day, buyers, sellers, investors should always look at the local market stats and the trends in that direction. But I think especially because of the election, the influence macro probably is a big deal for all markets.
100%.
Okay.
100%.
Let's get into it.
Okay, so the question is really like, how are home prices finishing 2024? And what a lot of people were talking about, it was they believed that home prices were going to end up slightly negative. Actually, right now, it looks like we're going to end up with single-digit positive appreciation in the 2 to 4% range, depending on which indice is measuring it. Now, the thing to understand about statistics is it always matters, like how the data is being cut, what data set they're measuring against. That's why you're going to see different numbers. And as we discussed, like you mentioned, home prices nationally, understand that real estate is a local sport. So you've got to get connected with like people like us in the Seattle metro, or just reach out to us if you need to be connected to someone somewhere else in the country. But you've got to ask the questions to the local expert of what's happening locally. We're going to cover the whole United States, but realize there's parts of the South where prices are getting beat up. And there's prices like here in the Seattle metro where we're almost at double-digit appreciation this year. And so when we talk about nationally, we're vanilla. We're slapping that over all of these markets. And then understand that as we do that, some are going to appreciate faster, some are going to appreciate slower. So we encourage you to subscribe to us and just be along on this journey with us. And then ask us any questions you have in the comments about specifics for our area, or even if you need to be connected to someone in Dallas, we've got someone in our network that we can connect you with.
That's still pretty crazy though, because we started off the year with record high prices, or kind of getting up there, and then we hit it, and then we're still appreciating through 2024.
Second highest unaffordability since the 1970s. Stupid high interest rates. Well, late 70s, early 80s. Stupid high interest rates and massively unaffordable, while everyone's also being pinched by inflation.
Yeah.
I mean, crazy.
All right. So what's the lowest, highest, and average home price predictions for the U.S.?
This is actually kind of crazy. Like, this is how big the gamut is. This is why, you got to be looking at the data on a regular basis. Moody's predicts the massive crash, Benji, Travis, of 0.4%. And they are the lowest. Dun, 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 dun.
Oh, crazy. And so if you're listening to this, there's a graph here of all the different agencies, organizations, and, data researchers, including some banks. And so there's about 13, 14
There's
of them.
15 of them.
15 of them, and only one is predicting a crazy crash of 0.4%. The rest is all appreciation.
The rest is all appreciating. So 1 negative, 14 positive for those of you keeping score at home. Apollo Global Management, 10.8. I'm like, are you out of your freaking mind? So we're actually going to dig in. I went and read Apollo's report, and I'm going to talk about their top 10 reasons why they believe that's going to happen. I'm going to be honest, I don't think that's possible. 10.8% appreciation here in the United States. Now, the average, though, the average of all 15 of these is 3.5, slightly above inflation. That feels normal. Okay, feels very normal, feels very good. That seems doable for the U.S. Okay, so let's dig into the lows, the highs, and all of that jazz. So Moody's, Mark Zandi, he's their economist. He said, and we're only going to talk about the pieces of data I think that are the most important. And I got this data from Resi Club Analytics. You can go to their website, check it out. I'm one of their paid premium subscribers, just so we can see this type of research. So they said they expect prices to fall 0.4 in 2025 with a slight uptick of 0.7 in 2026. So Moody's is kind of being pessimistic here, but they actually give a really good solid foundation. We expect home sales to steadily increase as more exiting buyers need to sell for demographic reasons. Death, divorce, children, job change, lower rates help ease the mortgage lock. What they're talking about there is because we're just below 4 million transactions. We're at a transaction low right now, like a great financial crisis low. Like the current run rate is the same amount of homes we were selling in 1995. So once again, it depends on how you measure the data. They're saying we're in a have-to real estate market, and they don't expect us to improve out of the have-to real estate market into the want-to real estate market. Now let's go for the crazy guys. Apollo Global Management, and they are extreme bullish, and they're predicting 10.8%. So if the average home is 420 grand and 10.8%, they're saying the average home in the US is going to go up by over $42,000 next year. They wrote, higher mortgage rates are weighing on demand, but the lack of inventory, remains very low, and housing demand is supported by solid wage growth, high stock prices, and high cash flow to owners of fixed income, including private credit. Well, what are they saying? What's the English translation of that? They're saying there's not enough homes, we haven't built them, and because supply is so low, as rates come down, they believe demand's going to increase. So I want you to agree, disagree, or tell me they're crazy with their 10 facts about the housing market. These is going to be, tell me in the comments. U.S. homes are getting smaller. The size of new homes being built has declined by 12% since 2016. So smaller homes, more affordable, more demand, therefore increased prices. Now, I'm not saying I fully agree with this. If you didn't catch this, I don't fully agree, but this is what they're saying. They're saying the median age of all homebuyers is up to 49 years old.
What was it like 40 years ago?
31.
Oh, right there.
Yeah. No, I mean, this is scary. This is that lack of affordability. This is the destroying of the middle class that we've been talking about. This is the shit that pisses me off.
This is like be nice to your parents kind of information.
Be nice to your parents because you can't afford a home without them.
You have to live with them or get them to, oh my gosh, that's crazy.
So, but when you think about Apollo Global Management's logic, they're saying they're further along in their career. They've saved up more of a down payment. They have more money. Therefore, this is increasing demand. The home price model predicts the 10.8%. That's number 3. Number 4, 40% of U.S. homes don't have a mortgage. So they're saying those people aren't going to move. They're not thinking about moving unless rates massively drop. So there's a lot of supply that's locked up in that lock-in effect. The average number of homes sold per real estate agent is 21, down from 54 in 2004. I'm sorry, that data is totally wrong. Because let me just kind of noodle this out loud. There's about 2 million real estate agents in the U.S., and we sold 4 million homes. 4 divided by 2 is 2, not 21. I own 2 of the largest brokerages in the top 10 in Snohomish County, and our average agent does not sell 21 homes in a year. So according to other stats, that number, to be honest, is usually between 4 to 6. That's more of a normal number. The average agent sells 4 to 6 homes. So starting to discount this data, brother. Household equity. is at a record high, 73% of housing value. So that's true. We know that equity is at a record high is because home prices during COVID, they just went freaking vertical. A record high, 36% of Americans say they would rent if they were going to move. And so that's putting pressure on rents, even though most rent forecasts for 2025 are actually really low or even slightly negative. Okay. More than half of all mortgages outstanding have an interest rate below 4%. So that's number 8. That's totally true. So that's attributing more to that lock-in effect. That's preventing that supply from hitting until rates get fundamentally further down. 95% of all outstanding mortgages are a 30-year fixed. We know that. So during the great financial crisis, one of the things that happened was we didn't have as much fixed debt as we do today. There was about 30% of the loans were ARMs, and they were given to, the ninjas, the no income, no job, don't prove your credit, you don't have to actually qualify. And so that's what caused the great financial crisis. And now 95%, what they're saying is they're saying the housing market's really stable. They're saying those home buyers are really stable. They're saying their debt, it's an asset instead of a liability. Because whether it's a rent or mortgage, it's one of people's largest expenses every month. Last but not least, number 10 on Apollo Global Management's list, 63% of all mortgages outstanding were issued after 2018. In other words, they're all sitting at these lower rates when they were refinanced during COVID. So do you agree or disagree? Is Apollo Global Management correct? Like, could we actually get 10.8%? Let me know your thoughts. I'm just not there for this one. I'm bullish, but this is too bullish.
Can I ask you a couple questions?
Yeah.
So you said that this agent information was inaccurate, but what would you say in 2004, I mean, just broadly speaking, the average agent was doing?
The average agent in 2004, it was actually probably around the same amount. No, actually, it would have been higher. Let me explain.
Would have been higher than 54?
No, it would have been higher than 4 to 6.
But what would you have said?
Well, let me dig into the data. So in 2003, 4, 5, 6, and the beginning of 7, what we had that construction boom. And that construction boom, because it was so easy to finance, allowed more available sides per agent to come into the market. So the average agent then was probably selling between 6 to 9 homes a year.
So let's just average it 8, right?
8. And today they're probably averaging 5.
Got it. So that's not quite as dramatic of a drop, but still that's 30% drop?
Yeah,
25%?
30, 40%, absolutely.
Yeah, versus their drop, they're saying 40%. But the other thing that this thing doesn't tell you, and I don't know if this is worth it or not, but it kind of, again, the data is only as good as the data they're using, right?
Bingo.
And what they're trying to say, and you and I both know there's missing things from this.
Yes.
How many agents aren't working at all? Have quit, right? Compared to this, the amount of agents that were working was growing, right? And
Yes.
the number was higher. And now the agents that have quit, so it's making the number even more skewed. Does that make sense?
Absolutely, it is. Because, so that term quiet quitting?
Yes.
Quiet quitting massively currently applies to the real estate industry because it's not a regular job. You're a 1099 independent contractor who shows up. You're a business that houses inside of a brokerage. And what happens is when the markets are tough like this, instead of it being the 80-20, it becomes like the 5-95. And I can see this inside of the data inside of our market centers. Is that 5% of the agents who are doing all the business. So one of the things to ask yourself, if you're a home buyer, you're a home seller, you're an investor today, just ask the agent that you're doing, hey, how many deals do you do this year? If they haven't done more than 4 or 5, then you got an average agent. They need to say 10. They need to say 20. They need to say over 100 because that's a level of expertise and they know the market. What's really happening is because interest rates got so high and the transaction count, we're in a real estate transaction recession, agents have quit without just hanging up their license.
There's one more thing I want to ask you. I think that's really important on this. the lock-in owners, right?
Yes.
The people with less than 4% mortgages that are locked in. We're experiencing something that maybe has never been experienced in the history of humankind in relation to homes and mortgages. If you think about those high interest rates of the 80s, right? They started coming down throughout the 80s and the 90s, ticks up a little bit, goes down a little bit, right? And then we get the Great Recession.
Yeah,
And
it was a 40-year trend down.
right. And it went rock bottom, like
Rock bottom.
whatever. What's like the lowest people were getting, like 2%, right?
2.5.
2.5%. And we slowly started going up, right? And then we had the crash, but then it went way down again, but it went up. We've never experienced this many people locked in.
Never.
So think about this. We already have really bad inventory, meaning we don't have a lot of houses in the market.
Yes.
If you combine it with the fact that there's people in their homes that want to stay in their homes because they don't want to lose their interest rate, including like someone like me, then this problem of low inventory is even worse. And then you combine with the one thing that you don't say, not a lot of permits for new construction.
Bingo.
So, by the way, I don't know if I'm kind of forecasting
you're totally
this,
fine.
but just looking at this data alone, appreciation is inevitable.
Bingo. Demand is outpacing supply due to the lock-in effect and the lack of homes that we've built since the great financial crisis. The only place where demand is getting greater is where new construction could exceed supply. Where's that? That's in the South, in the Sunbelt areas where there's lots of land, and we had the great migrations during COVID for the work from home on my laptop movement, where I could move to Arizona, I could move to the Carolinas for cheaper living. But now they're building so much in some of those areas that there are prices that are going down in some of those areas. But that's not reflective of the whole market. The second you go north or get out of that Southwest and go northeast, northwest, there ain't no supply.
Yeah, but even those markets, they just got so crazy prices, right? No one wants to pay that much to live in Arizona, honestly, okay? I don't know how much better Washington is than both benefits. So the last thing I'll say is this. We are in a interest rate and inventory crisis right now. No one kind of describes it like that because most people aren't real estate geeks like this. Yeah. But if you think about that, that is overshadowing almost everything else. Oh, I forgot. Inflation.
Yeah. Oh,
the 3 I's.
Let's say it again. Inflation,
3 I's.
Inventory, and interest rates. Oh, the 3 I's. That's really good. Said another way is we have a housing crisis, and that housing crisis is based on massive demand with a massive lack of affordability and inventory. And until affordability and inventory get in line, you won't see a massive rise in home buyers entering the market, and especially first-time home buyers, and especially that median age going down, where the younger people, the people with less credit, less income, less savings, less time at their job are finally qualifying.
All right, so obviously some people are saying we could have one organization saying we're going to have depreciation by a minuscule amount. Somebody else, Apollo is saying 10%, but the average is basically saying in the consensus, more likely that appreciation is going to happen. What else do people need to know in terms of 2025's, home prices?
The AEI Housing Center predicted 5.5%. Here's what's interesting, though. When you dig into what they were talking about, the average borrower FICO score for purchase loans is 739, just shy of the highest level since 2013. So the people that did purchase homes in 2024 were some of the most qualified buyers from a credit perspective in over a decade. That's That's really amazing. So when people talk about this idea of like, oh, a crash is coming, nobody qualifies. Are you freaking kidding me? These were the best qualifying buyers in the last decade.
You have to, right?
They had to, with a 739 average credit score.
Why is that significant?
That's significant because one of the things in the great financial crisis when we had those ninja loans was we were giving loans out at 550, at 600, at 620. And we know that Tiger never changed stripe. And what I mean by that is if you have a history of defaulting on your debt, of not doing the right thing, you're probably going to do it again. These buyers have a history of doing the right thing, of paying their debt back. So I just wanted to throw that out from...
Oh, so less likely for like some kind of crazy
less likely for some
crisis.
foreclosure or crash. Wells Fargo came in at 4.9, Bank of America 4.7, Goldman Sachs 4.4, Capital Economics, which was interesting, they're saying 4% in 2025 and 4% again in 2026. I couldn't figure out exactly why they were saying that, like where that prediction was coming from, but to hit above average appreciation 2 years in a row, they must really believe the economy is getting ready to transition into something magical. Okay? Because national home price appreciation is generally like 3%, slightly above inflation, which is supposed to be around 2. Fannie Mae, they believe that we're going to hit 3.6 in 2025. And then followed by a slight uptick in 2026. In other words, they believe there's pent-up demand in the market, and that's going to bring us in 2025 and then slow down in 2026. What I love when you look at these things is how all over the board it is. Okay? This is why you got to get in touch with your local agents. You got to get in touch with your local market. You need to become the local economist if you're going to be a hardcore investor, a hardcore buyer, and understand things like jobs. Because here in Seattle, we know that Microsoft laid off some tech workers. Well, if Microsoft continues to lay off a bunch of tech workers and those high salary jobs, that could start to create problems. Today, it's not. Boeing, being the largest employer in Snohomish County, when they went on strike, there was a brief moment. We talked about it on other episodes where we're all going, what's going to happen? Because there's 50,000 people not working. Fortunately, they got that back in line, but this is why you got to watch the local data so much. Housing Wire. Housing Wire does always a pretty good job, and they also own Altos Research. You can listen to or watch Mike Simonson over on his channel. He does a great job of going through the data on a weekly basis. They predict 3.5% in 2025, and that obviously there's going to be local markets that vary in performance. In general, the weakest home prices in the U.S. are those that have the greatest in unsold inventory, and most of those markets are in the Sun Belt growth cities, like we had just talked about. They literally just said it again. Morgan Stanley calls for 3%. Zillow, they call for 2.9 in 2024 and 2.9 in 2025. Their economist wrote, opposing forces are working to keep home values climbing, but only at a moderate pace. This was so well said. Like out of everyone, I was like, man, Zillow, you nailed it. Inventory remains low by historic standards, paired with expectations for declining mortgage rates and modest improvements in other lending indicators of home sales, is helping to buoy home value appreciation. At the same time, modest increase in new for sale listings and persistently high mortgage rates are limiting that price growth. In other words, low inventory, good demand, but it's still unaffordable, so it's not going to grow faster. We need to look at mortgage rates again, but right now it looks like most of the predictions for mortgage rates, we don't get below 6 right now because of how high they are. So what Zillow is saying, what some of these other people are saying, is that's going to prevent that rapid appreciation due to the lack of affordability. CoreLogic 7.3, Zelman and Associates 3.1, 2.3 in 2025 and 3.1 in 2026. In a Barron's article, Ivy Zelman talked about the strongest and weakest housing markets, and she said the weakest and most pronounced are in Florida, Tampa, Sarasota, Naples, Orlando. So all those in Florida. And then areas in Texas such as Austin and Dallas are weaker. while areas in the Northeast are resilient once again. So once again, that overbuilding. So when you see these stats, because I've seen them on X, aka Twitter. I've seen them on TikTok, and they go, new construction is overbuilt, it's crashing. New construction is overbuilt in specific markets in the South, while the majority of the United States is still underbuilt on new construction. But what they do is they use that national data to trick you. Our listeners, our subscribers know to go dig into that data, to go 3 deep, to validate, and then to ask your local real estate broker what's really happening. Next, you got NAR, the National Association of Realtors. They're calling for 2%. Okay? And NAR's the trade industry. If they're calling for 2%, they're generally really bullish. This is probably a good call. And then 2.3 in 2026, what Lawrence Yun wrote, their chief economist, he said, strong price increases cannot be sustained for another 5 years or America will be divided, with only a few getting to experience a tremendous housing wealth. If we bring more supply to the housing market, home price increases will not be as outrageous and will be more in line with wages. Go, Lawrence, go. I mean, he's preaching our message right now. And we hope that Doge, go Elon, go Vivek, and the Trumpinator through Trumponomics can come through, lower some of this regulation, and get more housing built. That's a way to fix this housing crisis. And like Lawrence was saying, get more buyers to experience it instead of the average buyer being freaking 49. We need the middle class. Okay, Mortgage Bankers Association. What's interesting, another trade organization, 1.5. Freddie Mac, 0.6. And we already talked about Moody's at the bottom. So I want to give perspective. According to the St. Louis Federal Reserve website, the median sales price as of October 24th, 2024 is $420,400. And so if we know the market appreciates at 3.5%, that means the average home will cost $14,714 more in 2025, making the finished home value or the median price around $435,000 next year.
For the average home price in the United States.
For the median home price in the United States. You are correct.
Compared to right now or in this season, 420,000.
Compared to 420,000.
So the quick, simple answer is home's going to get more expensive next year based off of what the St. Louis.
Based off the St. Louis Fed. Yeah. Based off of all these economic predictions, it's 14-1. They say home prices are going up. What do you say, Benji?
Home prices are going to go up.
I'm making the same bet. Home prices are going up. I mean, it sounds crazy, maybe a little ridiculous, but like the data says home prices are going up.
Yeah, well, and this is the thing. Even if it only went up 1 or 2%, it's going up 1 or 2% based off of the most unaffordable home prices.
Based on super high home prices with unaffordable interest rates.
All right, so let's get into what would cause prices to crash and what caused prices jump dramatically.
Yeah, so this idea of like, okay, now that we've gone through what they're saying, let's give our listeners, our subscribers, people on Apple, give us a rating. We need another rating and a review. Give us things for you to pay attention to just in case. Okay, because you never know what could happen. We don't know what's going to happen 90 days from now. We don't have a crystal ball. So I want you to pay attention to what the Federal Reserve has been saying. The Federal Reserve right now is talking about another cut in December. Therefore, rates are probably going to go down. The 10-year Treasury looks like it's peaked, and it's sitting inside of this little channel. Okay, for you stock traders, you know what I mean. It looked like it might have been a head and shoulders for a second, but right now it's channeling in a downward direction. So we're going to bet rates are going to go lower. But the Federal Reserve is talking about unemployment. So I want you to watch the unemployment numbers nationally. I want you to watch the job openings and then unemployment in your local area. If you see unemployment rise, that could cause a pricing problem. People have to have jobs to be able to afford their mortgage, to be able to afford rent, to be able to buy. So that's number one. Obviously, major economic downturn, change in GDP. This should go without saying. Just watch the national GDP numbers. Watch what's happening in your state. If we went through another rapid rise in rates, so let's say inflation came back and all of a sudden Papa Powell had to Paul Volcker us, and he had to jack rates up again. When you
I don't want to get Volckered.
Well, he already Volckered us, so we know what would happen.
It hurt.
What happened was when they raised us 550 basis points or 5.5%, prices did drop in 2022. So we know if we have to go through that, that would cause prices to drop again. A massive rise in inventory. To be honest, I don't know what would cause that right now because we're so far behind, but this is a factor. A rapid rise in foreclosures. Realize foreclosures today are at almost an all-time record low today. So foreclosures have to 10x their current position for us to get to the great financial crisis levels. Rise in BKs. BKs are rising. Okay, that one's happening. We need to keep watching that one.
BKs being bankruptcies.
Being bankruptcies. Thank you. Consumer confidence. Consumer confidence rose in the last report, but always watch consumer confidence. We're a consumer-based economy. Consumer confidence drops. The consumer starts spending. This thing stops. Home prices could go down. Increased lending standards, overbuilding, speculative bubbles, politics, both local and national. A recession, okay? Geopolitics, natural disasters. This is what can cause home prices to fall. So in the places the hurricane struck, horrific hurricane, home prices in those areas, of course they went down. But natural disasters of any type can cause it. Next, we got to go through this idea of okay, well, that's what would cause them to fall. What would cause them to rise? Number one, low housing supply. Supply. On a certain level, I don't understand how many times we're going to have this conversation. Housing is a supply and demand market, and it's not as elastic as other markets. In other words, it doesn't move as easy and as fluid and as quick. It moves slow like an aircraft carrier.
Because interest rates, you could just drop 1 or 2% in a matter of months versus you can't just 100,000 houses certain politicians were saying they're going to do. When they
You can't because, well, let's just think about it. We build homes, and some of them we build them in record time. And even in record time, it still takes 60 days to build a home, but that's assuming you already have the permit. That's assuming you already have the land. So for most places throughout the country, to start a home today, you're 4 to 6 months away. And then here in the Seattle Metro, may God have mercy on your soul, you're 6 to 18 months away, depending on where you're at. Okay, high demand. Of course, it's going to cause prices to rise. That demand is going to be directly influenced by interest rates. So we put interest rates as number 4, but demand and interest rates, they're twins. They're hand in hand. As rates go down, the buyer's monthly payment is more affordable. As the payment is more affordable, demand goes up. The same thing applies to investors. Investors buy more as things get cheaper. Economic growth, number 3. As the economy grows, consumer confidence feels good. You feel good about what's happening. Your stock portfolio grows. If people's stock portfolio, if the market keeps ripping and Bitcoin keeps on a tear and the S&P 500 keeps going up, that economic growth will support higher home prices. Government policies, aka tax incentive, aka deregulation, aka lending standards, those can help. Doge is still not coming to save you, but they might help.
You missed low interest rates, by the way.
Yeah, and I kind of just tagged low interest rates in with the high demand.
Oh, got it, yeah.
Because I feel like they're twins.
Yeah, for sure.
They run with each other. Inflation. As inflation comes down, if inflation keeps coming down and you start to get low inflation and maybe wages slow down or cost of material, if it's less labor to build a home or less labor to repair a home, or the materials are less because inflation's going down, that supports higher prices because it's cheaper to do it. Real estate investment trends. What I mean by that is as markets improved, more wannabe investors invest. As interest rates go down, the commercial real estate market will start healing itself. People will start cycling their capital more. What they do is as the economy improves, they start holding less cash reserves and they start putting more out to work. Last but not least, climate, natural disaster, and global economic trends. All of these can support higher prices, and I want you to be watching them both nationally and locally. Local is more important than national.
Real quick, I think this would be kind of interesting because we've already kind of agreed and looked at the data to come to a consensus of appreciation is more likely, right? And you said what factors could cause home prices to rise dramatically. If you think about the incoming administration, of course, Trump and his team and the way he wants to set up policies, you could actually almost say almost all these are going to happen, right? I'm going to just freaking go through these really quick. Okay. Low housing supply, funny enough, is maybe the only one that would be alleviated a little bit, but you and I both know it probably is going to take 2 to 4 years just to get it going. So this one probably likely to go into it, maybe not as extreme if there wasn't the right people in there.
I would say the low housing supply one, if they are capable of fixing it, will not be fixed until the latter part of Trump's term.
Got it. So this one, boom, is going to happen, right? Second one, high demand. Well, there would be high demand, like you said, if interest rates are lower. That's already starting to happen. And we already know Trump loves his low interest rates. Boom, that's going to happen, right? Economic growth. Like his whole goal is to put more money into Americans' pockets, to get businesses going. And then guess what? He's going to tariff the shiz out of the rest of the world to make America, as he would say, great again.
Protect America, American jobs, American workers, the dollar.
It's just kind of crazy. I'm checking all these off. Low interest rates, where you talked about that. Government policies, I mean, it's just going to be on fire, right? Inflation. This is an interesting one because everyone hates inflation, but tariffs are short-term inflationary.
100%.
And it's like you can't put it back in the bag. The inflation has been because of what we did in the 2010s and what we did during COVID. That's going to happen. Real estate investment trends. I mean, I guess you could answer that real quick. What do you think?
Real estate investment trends, that one is so dependent on interest rates. As interest rates go up and as the economy improves or people's stock portfolio improves, then, as interest rates go down, that's just demand.
Boom. It's going to happen. Infrastructure development, natural disasters, and climate factors. I mean, it's funny. All these happen, right? Global economic trends. That one's like the ones like we can't predict that, honestly.
You can't predict that.
But the natural disasters, the way we're going is probably going to happen. There's more of them coming. That's just scary. I just blasted through that. And when you're saying this, I'm thinking this is exactly what we've been talking about for like 3 to 6 months, especially with the politics and the policies. And then Trump winning just kind of like verified all this. So, we have a young man that's running this podcast and we were joking at the beginning, right? I don't know if he can show himself or not, young neutrally. And I said, hey, this is going to be depressing because it's either going to say you need to, be buddy-buddy with your parents, maybe have somebody that's going to help you out or buy something right now. Yeah. Because based off of this, and I don't know what else you have, but I mean, the quick summary for me is this. I don't see a way that home prices are going to come down at all, which is already scary enough because we're at record high prices. I've been waiting 14 years for home prices to go back down like it did right before, it's just not going to happen. And based off of that quick spitfire of facts is probably going to go up.
Facts and recency bias forces you into a logic fallacy. And that logic fallacy is that all recessions, home prices go down because we have recency bias to the great financial crisis. Our mind goes, home prices go down in recessions. And we already proved in other episodes, the vast majority of recessions, home prices do not go down. They just happen to in that one because that was caused by real estate, by lending practices we don't have today. Because these people have high credit scores, they have high down payments, they have good jobs, they actually qualified, and they have equity. Versus you fogged a mirror and you had a pulse, you bought a home pre-great financial crisis and then got foreclosed on. I mean, that's the difference today. Americans have genuine assets. Before they didn't. It was fake and it was on paper. I'm not saying they couldn't go down. Home prices could totally go down, but you're not going to see that massive crash that hardcore investors and buyers want to see. And what's crazy is you think this data is bad. Wait till we go through this data in Seattle. It's just worse.
Are we going to do that next week?
Yeah, next week we're going to go through how this data is just even worse in the Seattle metro and how we're out appreciating the rest of the United States. And based on our forecast, it looks like we're going to do similar next year based on the totality of the data. And we already lined it all out for you guys.